Welcome back to the Did You Know channel. The visuals in this video aren't as important as the information you'll get from it, so feel free to just listen in the background while you work, exercise, or do whatever else. Today we're taking a look at the current market situation, and it's pretty wild. The markets keep selling off, Warren Buffett has completely closed his position on the S&P 500, and the trade war between major powers is escalating. What does this mean for the market? Where could this all be heading? And what can investors and traders do about it? Today, we'll go through the latest data, compare it with historical situations, and most importantly, try to put together a rational perspective on what's happening. So, let's get into it. So, what's actually happening in the markets? If you've been following the indexes, you've probably noticed that Nasdaq futures is currently weakening. As I'm recording this video, we're seeing a 10% correction, which is exactly the threshold that analysts consider a typical market correction. Now, here's an interesting statistic. On the S&P 500, a 10% correction happens about once a year, on average. So, this isn't something unheard of. It's actually a normal part of the market cycle. Of course, nothing in this video is financial advice. Everything I'm sharing is just my personal opinion and observations. It's always important to do your own research and make decisions based on your own strategy. But back to the current situation. S&P 500, SPI, is down about 7%. Nasdaq is testing key levels, and once again, all eyes are on the 200-day moving average. For those familiar with technical analysis, when the price stays above the 200-day MA, the market is considered strong and bullish. But if it breaks below and closes there, it could be a signal for further sell-offs. We saw something similar back in 2021, when the price broke through the 200-day moving average, tested it several times, and then experienced a sharp decline. The big question now is, will this pattern repeat, or will the market hold? Right now, we're in the middle of a correction, but what really matters is how the market reacts at these levels. Will the sell-off continue, or are we about to see a rebound? We'll have to wait and see. Looking at the S&P 500, specifically the SPY ETF, we can see that the market has dropped about 7%. The Nasdaq isn't doing any better, and right now, both of these major indexes are sitting right on the 200-day moving average, and that's a big deal. For those familiar with technical analysis, the 200-day moving average is one of the most important long-term support levels. If the price stays above it, the trend is still strong. But if it breaks below and closes there, it's not a good sign. It could mean the market is heading for further declines. Now, let's take a look at history. Back in 2021, when we had a strong rally after the COVID crash, the market tested the 200-day moving average multiple times. But as soon as it broke below, it started forming lower highs and lower lows, and that was the beginning of a significant correction. And now, we're in a very similar spot. So, what can we expect? If the market breaks below the 200-day moving average and stays there, we could see more selling, possibly down to levels we haven't seen since early this year. On the other hand, if it bounces off this level, it could be a sign that buyers are stepping in, and this could act as a strong support. Right now, this level is the one to watch because it will determine where the market goes next. And that's what investing is really about. It's not about predicting the future, but recognizing key moments and making informed decisions. So the big question is, will we break lower and continue the sell-off, or will buyers step in and stop the decline? The next few days and weeks will tell. Now, let's take a look at historical parallels, because we've seen this happen before. When we look at the past, we can see that the market has been in a similar situation before. 2018 is a great example. Back then, the Fed was raising interest rates, fighting inflation, and at the same time, there was a trade war with China. The markets reacted with a significant decline. And right now, things look very similar. We have tariffs, inflationary pressures, uncertainty around interest rates, and if we look at the charts, Nasdaq dropped by minus 23% back then, officially entering a bear market. S&P 500, SPRI, fell right to the minus 20% threshold, which was a key level that eventually led to a bounce. Could this scenario repeat itself? Of course, the economy isn't exactly the same as it was in 2018. Things are constantly evolving, and the factors at play are changing, but we can definitely see clear parallels. That's why it's important to have scenarios prepared. What to do if the market drops further, and what to do if it bounces. So, If we were to see a similar pattern to 2018, that would mean S&P 500 could drop to the 490-500 range, where there could be strong support. If that happens, it might present a big opportunity for long-term investors. On the other hand, if the market stabilizes and bounces, it would confirm that the long-term bullish trend is still intact. Right now, the key thing is to watch whether history repeats itself or if the market reacts differently this time. And now, let's take a look at how the trade war fits into all of this and what it means for the future. Now, let's talk about the trade war because it plays a huge role in what's happening in the markets right now. Trump has imposed tariffs on Mexico and Canada, 25%, and on China, 10%. And there are ongoing discussions about potential tariffs on European products, especially in the auto industry. And if history tells us anything, we can expect these countries to retaliate with their own counter tariffs. So, what does this mean for the economy? Well, the first thing to understand is that big companies saw this coming and prepared for it in advance. Many businesses stockpiled goods before the tariffs took effect to avoid extra costs. But this created a major short-term impact. Imports spiked, which led to a decline in projected gross domestic product, GDP. Specifically, the Atlanta Fed predicts that GDP growth in Q1 2025 will drop by -2.8%. At first glance, that sounds pretty alarming, but when you look closer, it's not necessarily a disaster. This decline is mostly due to companies stocking up earlier, meaning they aren't importing as much right now. So, in the coming quarters, we could see things balance out again. The second major impact of tariffs is inflation. When imported goods become more expensive, businesses pass those costs on to consumers, which drives prices higher. On top of that, Trump also plans to tighten immigration policies, which means less cheap labor in the U.S., again, pushing costs up. And that brings us to the Federal Reserve's response. Right now, the Fed is sitting on the sidelines, doing nothing, waiting to see how things unfold. Originally, markets expected rate cuts in 2024, but now analysts are starting to doubt whether that will happen at all. Some believe the Fed will successfully pull off a soft landing, meaning they'll control inflation without triggering a recession. But others argue that this plan will fail and that we're heading toward a significant economic slowdown. So, right now, we're looking at a mix of higher tariffs, slowing GDP growth, and uncertainty around interest rates. And all of this is creating market tension, which is reflected in the current sell-off. The big question is, how should investors and traders respond to this situation? And that's exactly what we'll dive into next. Let's take a look at how investors are reacting and where they're moving their capital right now. So, when we look at what's happening in the market right now, we can see that investors and big funds are moving their money into safe assets, and that tells us a lot about their expectations. When stock indexes are falling, investors look for safety, and that's exactly what's happening now. Bonds are rising, and if we look at TLT, an ETF for long-term U.S. bonds, we can see that it's been trending upward since the beginning of the year. And why is that? Because when investors buy bonds, yields go down. For example, the 10-year U.S. bond yield was recently at 4.8%, but now it has dropped back to 4.3%, a clear sign that big players are shifting capital into bonds. And it's not just bonds. Defensive stocks are also gaining strength. Companies like Pepsi and Coca-Cola are moving up, while tech stocks continue to sell off. This is a classic scenario. When the market feels uncertain, money flows into lower-risk assets. So right now, it's clear that investors are not playing aggressively but are looking for safe havens. But what if this trend reverses? And this is where option selling comes in. In uncertain and volatile markets like this, selling options can be a powerful strategy. When volatility is high, option premiums go up, which is why many traders are focusing on selling options right now. Even if the market isn't making big moves, you can still profit from time decay and falling volatility. And that's exactly what we discussed in the live room, where we broke down strategies to take advantage of this situation. So, investors are moving into safety, the markets are uncertain, and volatility is high. The question now is, how do we position ourselves for what's next? Let's take a look at Buffett's move and what it might be telling us. Now, let's talk about one of the most talked about events in recent days. Warren Buffett has completely closed his position in the S&P 500 ETF. Yes, it's true. If we look at the latest reports, we can see that Buffett sold 100% of his holdings in SPI, S&P 500 ETF, and VOO, Vanguard S and P500 ETF. So, naturally, the question arises, what's his reasoning? Does he know something we don't, and should we be worried? But first, let's add some context. Buffett's company, Berkshire Hathaway, manages a portfolio worth hundreds of billions of dollars. So when we look at the size of his position in these index ETFs, it was only about 0.01% of his total portfolio. That means this isn't a massive move that fundamentally changes his investment strategy. So, what does this really mean? The most likely scenario is that Buffett was simply cleaning up his portfolio, getting rid of a relatively small position that wasn't significant for him. Another possibility that's being speculated is that Buffett believes the S&P 500 is currently overvalued. If we look at the PE ratio, price to earnings, index valuations are high, and companies would need to generate significantly higher earnings growth to justify these prices. And in the current economic environment, that might not happen. What's also interesting about this move is that Buffett isn't selling everything. He still holds major stakes in individual companies that he considers undervalued. That means he might not want to be too exposed to the index as a whole, but he still sees opportunities in certain stocks. So, while this may have seemed like an alarming headline at first, when we break it down, there's no real reason to panic. His sale of S&P 500 ETFs is more of a symbolic move than a major warning sign. Either way, this move reminds us of one important rule. Don't buy stocks just because they're popular, but look for real value where others don't see it. And now, let's take a look at market seasonality and what historical patterns in the S&P 500 can tell us. When we look at the historical patterns of the S&P 500 over the past 20 years, we can see certain recurring trends. Of course, every year is different, but some seasonal tendencies keep repeating. Here's how the typical pattern looks. January is often positive. The market gains momentum as investors return after the holidays. February usually sees some consolidation, but the market still holds up. Mid-February is when we typically see a decline, and that's exactly what's happening right now. March and April are mixed, but late March often brings another round of selling. Spring and early summer are generally strong. But then we get the famous sell in May and go away, leading to a market pullback. Now, let's compare this with how things are shaping up this year. The year started with a small dip, then a rally, some consolidation, and a new high perfectly following the seasonal pattern. Then, in mid-February, the sell-off began again, matching historical data. Of course, seasonality is never 100% accurate, but it can be a useful tool for market orientation. But here's a warning. When investors discover a pattern, they often start believing in it too much, and that can be dangerous. It's common to see a market repeat a pattern a few times, and people assume it will always work that way. But the reality is that every year has its own unique factors, and blindly relying on seasonality can be risky. That's why it's important to combine multiple factors: seasonality, technical analysis, fundamental data, and of course, proper risk management. Because no matter how promising a seasonal trend looks, the market can always do its own thing. So, while seasonality gives us a useful framework, it's not a strict rule that we can blindly trade on. And that's what investing is all about. It's about stacking probabilities and advantages in our favor. Now, let's move on to the strategies that might make the most sense in this market environment. So, we have volatility, sell-offs, uncertainty around the Fed, trade wars, and investors moving into safe assets. How should we respond? The first thing to clarify, are you investing long-term or trading short-term? Because those are two completely different approaches. If you're a long-term investor, these market dips could be buying opportunities. If you fundamentally believe in a company that is trading below its fair value and is testing strong support levels, these sell-offs might be the perfect time to start building a position. But if you're trading short-term, it's a whole different game. Here, it's crucial to understand whether the market is making new lows or new highs, where volatility is, and what the current trends are. That's why many experienced traders are now focusing on selling options. When volatility is high, option premiums are inflated, and that creates an environment where selling options can make a lot of sense. Why? Because if you sell an option far from the current price, and the market never gets close to that level, you can collect the premium without needing to predict the exact direction of the market. And in a chaotic environment like this, where prices are swinging up and down, that can be one of the more stable strategies. Another approach is to wait for trend confirmation. If the market breaks key levels, whether it's the 200-day moving average, strong support, or resistance, and closes there, that could be a signal to enter a trade in the direction of the trend. And of course, money management is absolutely crucial right now. When markets are unpredictable, taking on too much risk can be dangerous. Keeping control over your capital and avoiding impulsive decisions is often the difference between success and failure. So, the takeaway? Long-term investors can take advantage of the sell-off to buy quality stocks, while traders can focus on high-probability strategies, like selling options or trading breakouts. And if the market still isn't clear, a simple rule: sometimes doing nothing is the best strategy. Now, let's wrap it all up. The markets are currently in a correction. We're seeing sell-offs, uncertainty around the Fed, rising tariffs, and inflation concerns. Investors are moving capital into safe assets, bonds are rising, defensive stocks are holding their value, and the tech sector is getting sold off. Looking at history, we've seen similar situations before, whether in 2018 or other phases of market cycles. And while history never repeats itself exactly, we can learn from it and prepare strategies for different scenarios. So, what's the key takeaway? Long-term investors might take advantage of the sell-off to buy quality stocks trading below their fair value. Short-term traders can capitalize on the high volatility by using option strategies or trading breakouts and strong support levels. And if the market is unclear, sometimes the best move is to do nothing and wait until things become clearer. So, what do you think? Where do you see the market heading in the coming weeks? Do you think we're going to see a repeat of 2018, or will things play out differently this time? Let me know in the comments. I'd love to hear your thoughts. And if you found this video helpful, don't forget to hit like, subscribe, and turn on notifications so you don't miss the next market analysis. See you next time.